Hey guys, TommyBryson here, and today I'm going to break down exactly how does index fund investing actually work, and how does it compare to stock picking and also mutual funds, and what exactly it actually means to be an index fund investor. And by the way, I've been doing this for the past like 2 years or so, and I started with $7.60 investing into index funds, okay? And today I have around $60,000 invested. So in reality, it just takes a little bit of time and consistency to actually get there. So every single one of you watching this video right now can start with $5 and build up from there and just keep investing over time. And I will tell you exactly what app I use to actually invest into, what I invest into, and how often and how much money I actually invest. So by the end of this video, you should know exactly everything about index fund investing. And if you're new here, guys, well, like this video, also subscribe to the channel and hit the bell so you're notified when I post a new video, which is every single day. And without further ado, let's get right into the video. Now, the first thing is this, okay? What exactly is index fund investing versus stock picking versus mutual funds, okay? What does every single one of these things right here actually mean? Well, the first thing is this, guys, okay? Whenever you think about index fund investing, I want you to think about an index as something that is tracking the performance of something else. Whether, for example, that is the tech industry, what is the overall performance? Or, for example, what is the index of the overall best NBA players out there? Or, for example, what's the index of the overall return on what it means to be a beauty guru? The point is that an index is just something tracking something, okay? That is all it actually means. So overall, whenever you think about investing into an index fund, what you're really doing is you're investing into something that's tracking an overall performance of whatever industry you actually want to invest into. So for example, picture having 3 separate buckets, and I just happen to have one right here because, guys, I'm a great YouTuber, okay? But the point is, picture this bucket is all about the tech industry, and this bucket right here is all about the real estate industry, and this bucket right here is all about the international industry. Meaning that, well, when we talk about the tech industry, this contains every single company in the stock market that's around tech, this one all around every single company that's around the real estate market, and this one every single company that's tracking the outside market of the US. And that's all it is. So basically, what you're tracking is the overall performance of that entire industry by literally buying every single company that's a part of that industry. And that's why whenever you hear, for example, I want to invest into the S&P 500, the index fund, well, in reality, all you really have is a bucket with the top 500 largest companies that are inside of here. And what you get is basically when you buy a piece of this bucket, you're investing into every single one of these companies, which means you're getting the average return every single year of that overall index. And that is all it means. Hopefully, my bucket analysis actually helped you. If it did, comment down below and let me know. Now, when it comes to stock picking, it is very different. Instead of investing into an entire bucket with the whole industry inside of it to get the average, well, a stock picker thinks he's actually smarter. So he goes inside of the entire bucket and he takes, for example, one stock and says, well, this stock right here, or 2 or 3, is going to be the winners for the entire year. And that might be, for example, a tech industry bucket. So say, for example, he's investing, for example, into Amazon, Apple, Samsung, all the tech companies out there. He's saying, well, I think Amazon is going to do the best. Maybe Tesla's going to do the best. And guess what happens, guys, okay? To do that, it takes an overall lot of work. And you have to go through hundreds of different companies to find companies that are actually valued at what their price is actually reflecting in the stock market. Because as you guys know, okay, just because a company is listed for an amount in the stock exchange, like, hey, Tesla is $2,000. Well, does that mean Tesla is actually worth that much? The answer is no. It all depends on the overall assets of the real company. And that's what we call the value of the company. And most people out there, they're not analyzing companies. They're not actually going out there and investing. What they're doing is they're picking the entire bucket and they're looking for things that basically they like and are eye-catching. For example, oh, I like Amazon. Oh, I like Google. Oh, I like Tesla. And they get them and they invest into it, but they don't understand the overall business and the overall financials. And that is called speculating, which is actually very dangerous because basically, if that company fails, you lose all your money. But when you invest into the entire industry, it doesn't matter if one company fails because basically you get to own the entire bucket, the entire industry. And that is a cool thing when you talk about index fund investing versus stock picking. Now, Tommy, I understand that, hopefully by this point, but what exactly is mutual funds and mutual fund investing, and how does it work and how does it compare? The answer is, well, it's a little bit like the perspective of stock picker, but also with the perspective of an index fund investor. Meaning, for example, what you do is, instead of just buying the bucket and leaving it do all the work for you, well, what you actually do is you give somebody else the money to invest into this bucket, and basically they might hold it for you passively, just invest, reinvest the money, pay you out some money whenever you want, a manager, a passive manager, and they might charge you 0.2%, 0.1% with Vanguard. Very low fees, okay? And that's great. However, you also have another type of managers, and those are called active managers, meaning instead of being like, hey, I'm going to invest and get the average, well, they say, no, I'm actually smarter than you and everyone else in the whole market, and I am going to go ahead and pick the perfect portfolio and outperform the entire market. Now, if this happens in reality, every single year, you'll get a perfect return that's actually above the entire average, okay? And that is the goal. Now, for this service, of course, it's gonna cost you a lot more money, meaning they might charge you 1% or 2% instead of just 0.1% or 0.2%. Now, overall, you might say, Tommy, well, what I want to do is hire a professional. A professional is going to do the work for me, and they're going to beat the market. But in reality, the facts show that mutual fund investors that are active, guess what? They're not actually beating the entire average. They're actually losing every single year. And on top of that, they're also costing you a ton of money. So by this point, you should know that basically index fund investing, or maybe a passive mutual fund, is the best way to do it. And the best company to do that with is probably Vanguard and Fidelity, because basically they have very, very low fees, okay? But I would always go with Vanguard. They've been here for a long time, and they also have a lot more assets, and basically they can charge you little to no fees, okay? And that's the entire point. So by this point, you should know what index funds are, what stock picking is, and also what a mutual fund is. You have the active investor, I'm smarter than everybody else. You have the passive one, holds on to it, does everything for you, but it's not actively trading, which means you get to keep more money into your pocket and they don't charge you as many fees. Now, the second thing I want to focus on here is basically the truth about professionals in the stock market. Because honestly, everyone thinks like, hey, I'm not as smart as these guys that basically went to Columbia University, NYU, MIT, all these fancy places, Yale, Harvard. I'm not that smart, so I'm gonna grab my money and trust it all to them, and that way they can get me the best return out there. But again, like I mentioned before, guys, okay, overall, the data does not lie. And data says that basically just investing into a low-cost mutual fund with Vanguard, or for example, into a low-cost index fund over the long term, you're going to make more money. It's also going to save you more money. And on top of that, you're going to have a lot less headaches, okay? Because in the end, guys, around 9 out of 10 mutual funds, around 8 out of 10 mutual funds every single year, they're not actually outperforming the market. And this is called basically an entire industry of people that pretend to be smarter than everybody else, trying to beat the entire market, but in reality, they're actually underperforming the entire thing. And to me, that's not a great investment. And the way I actually think about this basically is kind of like hiring two people to do a job for you, the same exact job. Now, person A is basically doing nothing, just getting you the average return and basically making sure your money is safe and not charging you a lot of money. And basically grab your money, rebalance it for you, make sure everything is safe. Yeah, great. But then person B tells you, hey, I'm going to do a lot more work than person A. I'm going to overperform the market every single year for you. And at the end of the year, person A gives you the average. Hey, we got this much, great investment. I'm not charging that many fees. Great, here's your money. And then person B is like, hey, well, guess what? The market had a terrible year. So in reality, I managed not to get you anything, but in reality, I still need my 1% or my 2% fees. And by the way, that 1% or 2% fee over a long period of time because of inflation and also compound interest and also opportunity cost, money you could have just invested, that's going to cost you over 33% of your entire portfolio value. So if you ask me, I always rather go with person A than someone that's hyper and doesn't know exactly what they're doing, and it's just costing me money every single year, and it's not even outperforming the market, because honestly, it's very hard to do. And even Warren Buffett says it all the time. You're better off with an index fund than this crazy guy charging you a ton of money in the market, okay? So that is my opinion on basically professionals versus just going out there and investing passively into an average index fund with Vanguard, okay? That's the entire idea. And the facts, the data, don't lie. Now, number 3. Tommy, how exactly do I do this, okay? How do I invest into an index fund? Well, there are 3 ways to do this, and every single way is a little different based on what you actually want to do and what you actually want to accomplish. The first way is basically an app that I use, and it's called ACORN. And remember when I told you I started out with $7.60? Well, this is the app I actually started with back in December of 2018. Today, I have a total of around $26,000 in there, but overall, with all the money I have in the market, it's around $60K, a little bit more than that, okay? But the idea is, with ACORN, I get to invest into a portfolio made out of the largest companies in the US, also companies outside of the US, also real estate, also bonds, corporate, and also government bonds. But the idea is I get to have a balanced portfolio, and that way, when the market goes down, I'm not really worried, because basically my portfolio helps keep everything balanced, because again, I am very well diversified. Now, ACORNs cost $1, and they do all the work for you. They balance your portfolio, rebalance it, and make sure everything is fine. So if all you want to do is basically, I want to invest my money and have it grow over time and not do anything whatsoever, well, ACORN is the app you actually want to use, and that's actually the app I use the most, okay? And by the way, it costs $1, but literally they also reinvest all the dividends you actually make to actually help your investments grow even faster. And once you have over $400 in that account, guess what? Your dividends actually pay for the entire annual fee of $1 times 12, like $12, but they get to do all the work for you. And there's also no management fee, which is also going to save you a ton of money, okay? So I highly recommend ACORN if you just want to invest your money and get started with literally $5. I have a link down below. When you sign up, you also get $5, which is pretty cool if you ask me. Now, the second way to do it is with an app called M1 Finance. Now, I'm guessing if you're watching this video, you don't know exactly what funds to pick, what stocks to pick, what to invest into, and you're wondering exactly what to do. By the way, my portfolio in ACORN is called Moderately Aggressive, and I actually use right now M1 Finance with that same portfolio with 80% stock ETFs and 20% bonds. But the idea is I just copied and paste my ACORN portfolio into M1 Finance. That's the entire thing I did. Now, if you want to do the exact same thing, I have a link down below, and when you sign up, you get to invest into what exactly I invest into. And by the way, I also have a Patreon link down below. If you want to talk to me one-on-one about anything, just sign up for my Patreon, and that way we can have a conversation, and I can help you set everything up also. But again, I have free videos all over the place here, so you don't really need to pay for anything, but all the videos are also linked down below. And the last way to do it is basically with Vanguard directly, okay? Now, when I tell you to invest into ACORN and M1 Finance, the investments you're actually making are actually with Vanguard. The whole cool thing is that basically you can invest with $5 with ACORN and $25 with M1 Finance. However, if you do invest with Vanguard directly, usually it'll cost you $300 to $500 to actually get started. And when you buy an investment, you have to pay full price for it. So it's not really like beginner friendly. You have to have some money. But if you want to do Vanguard, just make a savings goal, put some money aside, and then just invest into it. However, if you're just getting started and all you have is $5 or $10 or $25, the answer is just start with ACORN. And then if you want to get more intricate, just do M1 Finance. But I highly recommend just do ACORN and just transfer the portfolio over to M1 Finance. And that's what I did. Again, links down below to everything. And now the last thing is this, guys. If you made it all the way to the end of the video, you're probably wondering, Tommy, how much money do I invest and how often do I actually invest? Okay, the answer is I recommend doing 10% of your overall income every single time you actually get paid. So for example, if you get paid weekly, $700, I want you to invest a minimum of 10% times 0.10. The answer is that's around $70 every single week when you actually get paid. If it's bi-weekly, do it bi-weekly and set it up on auto pay in the app. That way it's done for you automatically and you do not have to think about it whatsoever. And on top of that, how often you invest, the answer is do it every single time you get paid. That way you do dollar cost average, which means that you actually get to avoid the risk of buying super high and then having to sell low, because basically you're buying every single week or bi-weekly and you basically get the average price every single year. And remember, this video is all about long-term investing. And if you invested, for example, $500 every single month at an 8% interest rate, according to data out there with the S&P 500, in reality, over 25 years, you would actually make around $473,000. If you reinvested the money you actually made, the dividends, every single time you actually got paid dividends, well, in reality, you would get around $689,000 at the end of that 25-year period if you just invested, for example, into the S&P 500, okay? That's the entire point. With this portfolio, it's going to help you be even more diversified. Again, links down below to everything, and comment down below, guys, and let me know, was this video helpful? Do you understand things better with my entire bucket method? Comment down below, let me know, and I'll see you guys tomorrow. Thanks for watching, and as always, if you like the video, like the video, and if you're new here, subscribe and hit the bell so you get notified every time I post a new video, and also follow me on Instagram, TommyBryson. And on top of that, before I go, if you want to watch another video basically on how much money I make from dividends every single month, we'll watch this video right here and click on it. I'll see you guys tomorrow. Thanks for watching, and as always, peace.